the sound, and I'm trying to figure out, are we a public room? What is this? Is this public? Chris, is this a public room? Oh. I'm going to restart the room then. Okay, 3, 2, 1. Hi, everybody. This is Josh Jelinski, the financial quarterback. And we're being joined by Cycles analyst Phil Anderson. For those who are not familiar with your work, Phil, can you describe your background in markets? You look like a member of Pink Floyd.
Background, I just was interested in American history, and I've been a property investor in Australia for a long time now, 30 or more years. And back in the very early 1990s, there was a major downturn, and I just happened to be reading a book by Fred Harrison called The Power in the Land, which detailed a regular property cycle. And I went from there, and he had studied he had studied English real estate, and I decided to study American real estate. And I have found that the United States real estate market exhibits very regular 18 to 20 year, what I would call land cycles, real estate cycles. And we roughly get 14 years up and 4 down. And it's been that way regularly since 1776. And it's just repeating like clockwork. It was so good. I learned my history from reading a lot of American history writers, and one day I found out that I was actually starting to know more about those writers than they were. So I decided to write my own book, and I eventually got to do that. And that was put out as The Secret Life of Real Estate and Banking, which details the very regular 18 to 20 year property cycles. They are absolutely fantastic to know. Once you know that, it can take a lot of stress out of the whole effort of investing. It's been fantastic for me.
So this 18.6 cycle, what led you to kind of figure it out? There's this book, and then it goes back from 1776. Is that correct?
Well, yes. It basically starts from about 1800 when the 12 states in the United States got together and, they formed a federal government, and the federal government started handing out all the land. And when you look at the data and the statistics, it clearly shows that in the land market right throughout the 1800s and the 1900s, every 18 years, regular as clockwork, the land market crashes. And it's very handy knowledge to have. And we're in the midst of a 1991 serious downturn, for those that can remember back that far.
So where are we now? Are we at the high point, the low point? Like what's the high? And what's the next high?
Good question. Well, everybody, I think most people can remember the 2008 crash, I guess you'd call it. And generally, as part of the real estate cycle, it's 18 to 20 years as a full cycle, and we get 14 years up roughly and then 4 down as a general guide. The United States. Now, I realise the United States is 50 different states, so I'm just talking as an homogenous US market. It's a little different state to state, of course, but as one homogenous rough market, US real estate bottomed in 2012. In 2012, it's a very simple calculation, roughly 14 years up. So we are not at the top of the real estate market yet. We've still got a couple of years to go. And I think if history is any guide, if you line up the real estate cycles one under each other, then we are roughly at a position last cycle of 2003. So you may recall from about 2003 up into 2007 was one hell of a ride. You might also note that in 2001 and 2002 we had a fairly significant recession. 2002 was a very dramatic year for the Nasdaq. In 2002 and into 2003, the Nasdaq was down almost 90%. I mean, can you imagine that? It makes what we've been through in 2022 look like absolutely nothing. So we've repeated that part of the cycle. If you go back to cycle prior to that, 1982, and then you look 1983 right into 1987, that was a fantastic end to the cycle as well. So I think we're going to repeat that. So I think there's plenty of oomph left in real estate and stock markets yet, and we're about to enter the final, what we call the 11th hour, really the final stages of the current real estate cycle, and I'm very bullish, very bullish. It's going to be really exciting to see.
Very bullish on real estate or stocks or both?
Both, especially stocks though, particularly stocks.
So what cycle do you follow for stocks? The 7-year cycle, which?
Well, it's interesting. It's interesting you mentioned the 7-year cycle. Here's something that listeners and viewers may or may not recognise, but the United States market, the stock market, tanks every 7 years. Now, if you trace that back, 2015, 2008, 2001, 1994, 1987, just to mention the last half a dozen. 2022 was not a surprise to myself and and my readers, people who follow me. 2022 was the 7th year, and it was due. And if you're a WD Gann follower like I am, Gann gets pretty big on the 7th 7, and 2022 was going to be the 7th 7, so it's every 49 years too, so that was going to be dramatic as well. And if you take your history back, following cycles further back than that,
84 year, 93 year, that.
Yeah, all those sort of things. But I don't need to get it that complicated. It's just every 7 years for the stock market, roughly. Not roughly, actually, it's exact. And then you just have to look at what the decade does. And as far back as you can go in US history, right back to 1800, years ended in 1 and 2 of each decade have almost always been down years. I mean, think about it. 2012, 2002, 1992, 1982, 1962 especially, they were very difficult years for the United States. So I didn't think it was very hard to work out that 2022 might be another difficult year, and you could be prepared for it. But from my point of view, where I stand now, I think the difficulties are past us. Slowly, it's not going to, we've still got a few, we're not out of the woods yet, but I think the difficulties are behind us now, and we're looking forward. And I think it's going to be very bullish. Years ended in 3 within the decade. So we're talking 2013, 2003. And so usually they're a transition year from the difficult year in years ended in 2. And then we go into year ended in 4, which all of a sudden becomes bullish. And then we get into 5 and 6 up years. So I'm just making an estimation that history will repeat. And I think we'll go from there. I think it's going to be absolutely stupendous. It's absolutely fantastic.
Now, have you published any books that our listeners know about?
I've had a book. The Secret Life of Real Estate and Banking, that came out in 2009, and I showed clearly all the history of the cycles, and then I forecasted there'd be another cycle repeating after 2009, and here we are.
And that book will be our free giveaway if you schedule and keep your no obligation review at 888-988-JOSH. I'll buy it for any of you who schedule your 45-minute 555 review, 5 ways to save on taxes, 5 ways to save on fees, and 5 ways to reduce risk in your portfolio. Call us now, 888-988-JOSH. And you can follow more of Phil's work. Where can our listeners, what are you promoting? Your newsletter?
Well, I write for a financial a US financial magazine now, Legacy Research. I'm part of their rogue economics team, and you can just Google Cycles Trader with Phil Anderson, and you'll see everything you need to see there, and you can follow up on all the e-letters that I write a couple of times a week, and go from there. Yeah, it's been an interesting couple of months so far. Certainly in March and February we were against the grain as such, and a lot of people are very bearish at the moment. But bull markets start out of very bearish negative sentiment, and it was a wonderful March to see all that bearish sentiment come to the fore. But that's how bull markets start. And when you let me add this too. When you one of my secret weapons is the ability to, I always tell the people that read and listen to my stuff, I always tell people that real estate investors need to understand the stock market, and stock market investors need to understand the real estate market. Usually you find people specialise in one or the other. They don't tend to do both. And I've done both. And on page 360 of my book, I put together a clock that gives you the sequences of how the real estate cycle unfolds. And what I was able to do within that clock was add in not just the real estate cycle, but add in what the stock market does in those particular segments. And let me give you an illustration of the practicality of that. Now, I know over the past month or so, the focus has been on some of the banks in the United States. But whilst all that saga was developing, the housing stocks, the home improvement stocks, they were just very quietly treading sideways underneath prior highs. This is very bullish for the housing market. They were not declining like the banks were. So it was really only one sector that was getting hammered. And so when you look at, also I think one of the advantages I've also got is that, I'm not always, when you're in the United States, and I love coming here, it's a fantastic place, and the people are always so friendly to me. But it's very easy when you're in here in the US, because there's so much to do and there's so much happening. It's very easy to get US centric sometimes. And one of the things I've been able to look at often is, what happens over in France and what's happening in the UK. And even sometimes there's even something happening in Australia, And there's an Australian stock at the moment called Brambles, which makes shipping pellets and various other things for all of the stuff we ship everywhere. The price of this stock is now into all-time new highs. And that's the market and the people that study those sort of things telling you that this company's in 9 months' time going to release higher earnings. I just find it impossible to call a recession when you've got stocks like that in the all-time new highs list. And then when you have a look at, in France, you see what's going on in France at the moment. They're protesting over having to work longer hours. The French are always protesting about something. And I don't blame them for protesting.
Let's talk about that when we return from the break. This is Josh Jelinski, the financial quarterback, with Phil Anderson, talking about French indicators, all kinds of stuff. And he's optimistic. He says the worst may be over. When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back with Phil Anderson. You can get his book by calling us and scheduling your free 45-minute wealth strategy session at 888-988-JOSH. Which French? So wait, this is just like logic class. How does one stock in Australia, how is that a bellwether?
Well, it's not just the one stock. Josh, not a lot happens in Australia, I can tell you. Australia's full of friendly natives and
there's
poisonous steaks and stuff. But it's in combination with other things. And the French stock market has now broken into all-time new highs, despite all the protests that are happening and everything else going on. And you've had LVMH, the guy that owns that, can't think of his name just at the moment. He's now one of the world's richest men, which is indicating that his stock and all the stuff they're buying, Hermes bags and everything else that the people are spending their money on, they're still spending their money. A lot of it's Chinese money, but nevertheless, again, when those sorts of activities are happening, I find it difficult to think that we're going to get a downturn anytime soon. I know there's pockets of America struggling a bit, but I still think there's larger pockets doing very well. And so with all those things happening, even the UK stock market is at all-time new highs, and just trying to break over them, despite everything you keep reading about what's going on in the UK, about all the Brexit drama still and the high inflation rates. It's not bearish. I just can't, with all that stuff in combination, and even the other two big stocks, Rio Tinto and BHP. BHP especially, mining a lot, making a lot of money, and its share price is doing very well too, just underneath all-time highs. They're still paying rather nice dividends. It's a lot going on, and sometimes when you get into the United States, and when I'm here at the moment, you don't get a chance to see that because, like I said before, there's just so much happening here. It's just so exciting to be in the country. It's just it's endless. There's just so many things to do.
What about people who say, okay, December 2021 was the high. We have yet to break that high, and you can just draw a diagonal from that high to where we are today, and we're just not pushing forward to new highs. So eventually we'll break down, and this market resembles like 07 to 09, and maybe March 2023 was the countrywide moment, and there'll be some other contagion that'll happen that'll just freak people out. Market goes down another 20%.
Well, I agree that the US market, it is, you've described it well. It isn't chasing its past highs yet, but it does take a while to consolidate the prior March banking issues at one or two stocks. Those things have to be consolidated and digested and things. But it's ongoing, and that'll be right throughout this year and a little bit of next year. But I think by the end of 2024, I think the United States market will be back up into all-time new highs, and I think things will be going really well. The tech stocks will be back doing their thing. Usually in the second half of every real estate cycle, it is the speculative end of the market that starts doing really well. So I would not be a bit surprised to see stocks like Apple and Amazon and others, not be a bit surprised to see them get far more into banking. And that'll just kick off a whole heap of new credit creation and all the banking sequences that involve with that. So I think there's plenty of opportunity to come yet that will push US markets higher after this year.
How low do you think it could go, the market, in this 2023 uncertainty?
Oh, well,
or do you think the worst is over?
I do. Let me tell you why I think the worst is over. Now, this is from a cyclical, historical viewpoint. I just have a look. I have found that history. Well, let me say, if I was to tell you history repeats, it's a bit of a bland, overused statement now. But what if I said to you that history only repeats in set timeframes? And so some of the key timeframes you can look at are 20 years ago, 60 years ago, sometimes 30 years ago, and 90 years ago. And it's remarkable similarity about what's been happening. The lows 20 years ago was in late February, early March. The lows 30 years ago were in March. The lows 60 years ago was very late February. You look back 90 years, and that was 1933. In March 1933, all of the banks were shut. The Roosevelt shut every single bank in the country, and they were closed for 6 days. And then no bank was permitted to open again unless it was sound. I mean, you can imagine what that was doing to the people, right? It must have been absolutely dreadful. But more to the point, when these things happened, it was March of the year ended in 3. And so it really wasn't a great surprise for me to see another bout of turbulence and nervousness in March of 2023. Now, the significance about that, some could say, and this is where I studied a lot of Gann, and I thought Gann was brilliant in what he was doing. I know sometimes, listeners may not have heard of him yet, but do Google W.D. Gann. He was excellent on on timeframes, and he was excellent in showing people how to read a market. Now, the low for the US markets in March was higher than what happened in October, and that was higher than what happened in June last year. So far, on what potentially could have been read as worse news than last year with a couple of banks collapsing, the US stock market stayed at higher prices. Now that's bullish. So until we see the March low broken, you have to be bullish, because that's what the market's telling you. That's the way I'd read it.
The March low.
Yes,
yeah,
the March low.
You
I'm
said
looking at the Dow.
June was lower than the S&P was lower in October. I don't have my Dow chart, but I'll take your word for it.
Yeah, well, S&P, they're pretty similar patterns.
But Dow October was the low, not
yes.
June.
Yes.
But maybe there was an intraday low. I don't know. I forget. There was one really bad day where I think it crapped out in the
But the more
June.
important thing is that the low in March was higher. And so I'm taking that as a fairly bullish signal at the moment. I also look at the housing stocks, and also in particular some of the copper stocks and some of the other commodities. They're starting to make a bit of a move. I also noted that BHP, big BHP, made a move on Oz Minerals, which is a copper miner. Gencor's, I think they're buying a US copper stock. And in the second half of every real estate cycle, which is one of the chapters of my book, I look at what indicators you can look for that tells you that the second half of the real estate cycle is in full swing and it's going very well. Copper, the price of copper. And usually in the second half of the real estate cycle, the copper price does really well. And I think that's underway already. And so that's another thing that tells me that the real estate cycle is really starting to get into full swing now.
Great. So for those of you just joining us, we're with Phil Anderson. Where can people find out more of your work, Phil?
Well, if you just Google Rogue Economics or Cycles Trading with Phil Anderson, I run a service called The Signal with Legacy Research and Rogue Economics. If you Google all that, you'll find me easily enough.
And we'll give you his latest book for free when you schedule and keep your no obligation review at 888-988-JOSH, 888-988-JOSH. Call us now. You get Phil's work back from, has all the cycles and everything. It'll be a good read.
Yes, it's had some, if you look at Amazon, the customer reviews, they're going pretty well. It's humbling really to see that so many people have been able to improve their investment scheme and what they're doing by having a better understanding of the real estate cycle as I describe it. It's been tremendous.
Wonderful. So folks, call us 888-988-JOSH for the 45-minute wealth strategy session. When we return, we have Stan Harley kind of in the background listening. He's a cycles guru. Maybe I'll get him to share some questions in a little bit. Stan's a member of the team here, chief market strategist. Would love to get a little counterpoint if he has time to chime in. I'm volunteering him. I didn't really tell him to do this, but maybe he'll break out one question. When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back. We're being joined by special guest in the studio, Stan Harley. Harley is a cycles analyst as well as Phil. So I always like how you get multiple cycles people. They all respect Gann or Elliott Wave or this or that. And they come up with totally different conclusions. So I didn't know if Stan had any questions as he's listening in the background.
Hello, Phil. Nice to see you.
Yeah, hi, Stan.
You can't see me. I'm off camera right now, but
that's all right.
a real
that's
pleasure.
Okay. Cycles, man.
Like you, I'm a big Gann man, and Bryce Gilmore also.
Oh, really? Bryce was he was Australian,
Yes, he is. Indeed. Yes. Have you done any research into the mathematics behind the cycles that you're studying? In other words, you postulate there's an 18-year cycle in the real estate market. Have you researched the math that underscores that?
Uh, indirectly. That's a difficult question for me in one respect, because as soon as you start Googling 18.6 real estate cycle and 18.6 and other things, you go immediately into the North Node and lunar cycles and stuff, right? So I'm not really wanting to go there that way today, but yes, the maths I find interesting. It definitely, with GAN and everything else, it lends itself into a little bit of planetary understanding. I've found it really intriguing, amazing, really. It's been interesting to say the least. And so far, if you go right back, you trace this right back a little bit beyond 1800, the way the US economy has moved over that 18.6 year cycle has been pretty sincere and pretty amazing to watch. But the only thing I will say, though, on that is that you have to put things in perspective. And whilst I'm calling for a good move up from here and lots of speculative activity to continue, that's not going to happen unless we get a lot more lending from banks and a lot more credit creation. And I think there'll be a bust sometime later in this decade. That's not going to happen either unless we get a lot more credit creation under our belt and things really going up from here. And that hasn't happened yet. It's still a ways in the future. So we've got to see how it goes. So you can't get a big bust until you get the big boom up. And I don't think the US is right in that perspective just at the moment. But I do think it's coming. And I say that because I think currently in 2023, we're lined up like we were in 2003 and in 1983 and in 1963. And what happened after 63, after 83 and after 2003 was just absolute total boom, completely. It caught practically everybody by surprise. And of course, people in 2007, nobody was looking back to say, oh, wow, the NASDAQ was down 87, 88%. Gosh, and here it is back at all-time highs practically. So history suggests, and the cycles suggest, and the 18.6-year real estate cycle suggest that it's a plausible scenario because it's happened in the past. And so I'm just going to look at history repeating like that because it has in the past, and I think it will again. And bull markets always start when there's absolute total pessimism, and we've got that. Well, we've had that at the end of March. So we'll just have to see what pans out. But it's going to be an interesting ride, I'm sure.
Interesting ride indeed. I certainly concur with your research in the 20-year cycle. That's been quite reliable.
Yes, yes, indeed it has.
Going back many years. The bottoms in 82, 62, 42, 2002, 2022. I was watching that as well, pointing it out to
remarkable, isn't it, really,
Josh.
when you look back?
Yes. And in fact, until recently, it was to the month.
Yes.
Which was
yes.
uncanny. 200. It was 242 months, is what it was.
Yes. Yes.
Quite
yes.
interesting.
They're important counts. That's on the trine. So you put the square and the triangle inside the circle, you can get some interesting results when that happens.
What concerns me as a cycles analyst is going back a bit further, and I've got data back to 1602, when the original stock market was conceived in the Netherlands. Going forward from that period of time, there appears to be evidence of a 94-year rhythm defining the highs. And that seems to be due in the 2022, 2023 timeframe. Well, here we are. So I hear your bullishness. What are your thoughts about this? What about the markets entering a plateau of sorts? Something akin to what we saw between, say, 1962 and 1983. For 20 years, the market traded sideways, and the market is measured by the Dow, with 1,000 essentially being a ceiling that capped the market for 2 decades.
Yes,
could you see something like that developing from the present?
Yes, in the United States, yes, perhaps there might be something that drags things a little bit sideways, but I'd still have a more bullish tone than bearish. But like I said, I made the point before as well. there's a lot of stuff happening in the rest of the world, in France, the UK, and certainly in Indonesia and Singapore and China's picking up, that I think eventually will in this instance drag the United States back into more trading, more drama, and stuff that will just help things get along. We've also, at what looks like, again, will be a very interesting presidential year coming up next year. And history tends to suggest there too that when the incumbent goes back in to seek re-election, lo and behold, the government finds a lot of money it didn't think it had and starts spending. So, that's on either side of the aisle of politics. That's not Democrat or Republican, but all the incumbents do that. So I think there's a lot of spending in government areas to come up too. So, and one of the tricks of the trade they'll find next year, and this was demonstrated in I read this in a book. The author doesn't come to mind at the moment, but by the time we get into mid-2024, the government starts sending out welfare checks early. They certainly don't get behind on that. They make sure that those issues, that the poor amongst us are well looked after, and make sure that they can vote. Again, we're coming up into an area where government's not going to tighten their belt. So we have to see. We have to see. You may be right, but I don't have a. It's not a crystal ball that reveals to me what's going to happen tomorrow and the day after. But I just look at the history, and I think the 20 and 60 year very bullish. So we'll have to see if it can push through some of the other cycles that you mentioned.
Yeah, that 94 year. Sometimes it's 84, 93. I always feel like it's changing, but people, that does worry me too, or the war cycle. There's that 90-year war cycle. And maybe that's what props the stock market up. Maybe we just have this burst of economic activity, but we shall see. We'll be back with more of your questions. If we have audience questions, you can type your chat in Clubhouse or YouTube. We'll go to your questions live for Phil J. Anderson, The Secret Life of Real Estate and Banking. That'll be our free book giveaway. When you schedule and keep your no obligation 45-minute Zoom strategy session from a perspective of wealth building and risk management, call us now, 888-988-JOSH, 888-988-JOSH. And when I return, I'm going to ask him, seems a bit, what about people who challenge cycles? They say, hey, this is just hocus pocus. You're pulling things out of your rear end. You're changing years, and one day it's a 20-year cycle. One day it's a 94. 1 year it's an 83. What do you have for critics of cycles theory? When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back with Philip J. Anderson, author of the book, The Secret Life of Real Estate and Banking, which traces the history of housing cycles. And I have an interesting, before I go into kind of a defense of cyclical analysis work, I want to give a good defense, because sometimes it does seem, I got to be honest, sometimes it does seem a little hocus pocus. And it's good after the fact, because you can see the cycle more evidently. But, say the 7-year stock cycle. Now looking back, okay, 2000 to 2002, 2007 and 2009, 2015, 2016. But I know like 2015 to 2016, I was very much into studying cycles then. And a lot of cycles theorists predicted, hey, doom was coming, and market corrected, but really it would have been better if you were a net long-term holder of equities and didn't sell because of the 7-year cycle. And then the 7-year cycle looks like it, perfectly lines up with January of 2022. But, you know, how do we know we don't have another contagion and things get worse for another 6 months or 9 months before they get better? So what say you to that?
I accept all that, Josh. That's okay with me. There's all these sorts of things. I would encourage your listeners and viewers, I would encourage them to do the following. Look at markets, study any particular cycle that you might want to do, read up on all the sorts of things that have been done. And I get my subscribers to do the same thing. But then, the most important part, overlay everything you think you know with the history of the real estate cycle. And if you go back to 1800, and actually, especially since 1955, because it's been near perfect since 1955, then the land price low, the bottom then in the United States. Overlay your knowledge of the real estate cycle upon absolutely everything else. And it's proven so far to be exceedingly reliable, exceedingly. And I find that generally from prior United States real estate price lows, and the last one was 2012, it's very reliable. You just get 14 years up. And it's been that way for a long time. And so far, we haven't hit 14 years up. And I still think that's on the cards, regardless of what else there might be. And I accept your comments. You know, people can mix and match sometimes and everything else. But my big thing, which I've found so enormously useful, the United States leads the world economy, will do for decades yet. And its real estate cycle is a reliable cycle. Now, you have to put that in some sort of perspective as well. Sometimes, and the cycle throughout the 1940s and into the early 1950s, there was no speculation. So if there was no speculation, you can't get a big boom and then you can't get a bust. So basically that cycle, nothing happened. So people don't see anything, but it was there. And you can measure these things pretty precisely, which I've done in my book. I show you where to look and what to do. And at the moment, the real estate cycle is indicating to me that there are still a couple of years left. We haven't run the race yet. Now, does that mean I'm going to be absolutely right? No, look, anything can happen. And a world war has been the one thing that has interrupted the cycle somewhat. And, you know, hey, the way things look at the moment, with a couple of idiots in charge of the Middle East and in Russia. I mean, you know, anything's possible. Who knows? You just don't know the mind of Mr. Putin and what he might do if he was ever cornered. So I can't say it from that point of view. And we are, as you've noted, some of the war cycles are around at the moment. But I've generally found, and if I had one learning exercise from my book, the biggest learning exercise I got from my book, and this is going to sound a little bit odd and peculiar, but the real estate cycle I found a way to repeat and repeat on time. So going forward, if the real estate cycle is to repeat, there are a couple of things you could look for. Very tall buildings being announced now. Throughout the years of 2004, 5, 6 and 7, every time I came to the United States and turned on the TV, we were getting the Paris Hilton show. I expect that to repeat in some particular manner. It'll probably be the Elon Musk show now, so we'll hang off every word that he's saying. When he gets bullish, he's bullish. And he was bearish. Last year we thought things would go to hell, but he was, that didn't last. So we will hang off the words of some of the famous Americans that are making lots of money and everything else, and suddenly we'll all forget what was happening in 2023, and we won't worry about the banks anymore, and then the cycle will find a way to repeat. So we just got to see how that pans out.
So I'm going to be a little bit critical. Okay, so I'm taking your 1955. I'm adding 18.6. I'm adding 18.6. I'm adding 18.6. Maybe I don't know how to add because I know it's 0.6 isn't really 6 months.
Yes.
But wouldn't the low, Stan, I know you've done math on that. Is the low 2012 or was it 2010?
Are you talking about real estate?
The real
now?
estate low.
real estate.
May of 2012. Yes.
May of 2012. Okay,
Yes.
so you would agree on the
Absolutely.
date.
Concur.
Concur. I would say be 2010.8 or something, or 2011. But anyway, the point. So if we go 18 years,
14 years up. 14 years up.
14
Takes you to
years
the top.
up puts you at when? 2026?
2026. 4 years down after that.
I would say, but here's a little bit of a challenge, right? We all know fundamentals are bad in real estate. New York Post just did an article, default risk grows on 1.5 trillion in commercial real estate debt, say analysts, because in 2025 we'd record low interest rates. A lot of people took out 5-year ARMs to buy big buildings, which I would argue, by the way, is we're already at that meteoric rise. I would say that kind of happened already from 2019 to today, and now we're kind of like sloping. And then I would see, just kind of from my reading the tea leaves, 2025 might be when things start to roll over. So I guess it's sort of like your numbers, although mine's just kind of observational. Because I think in 2025, you see 1.5 trillion in debt is due for repayment by the end of 2025. Then you'll have a wave of foreclosures, and it takes about 3 or 4 years to kind of burn off. So I would generally say that's right, but what is the top? 2025? Is it 2026?
Yeah. Josh, you make a very interesting point. Really interesting. You're quite right. I wouldn't argue against that in a way. What I would add to it, though, is which everybody forgets today, and economists don't measure. The Fed doesn't look at it. The most important fundamental is the land market, and as we go into 2026, as the land market, as you'd expect, it becomes more and more expensive. The stock market will tell us how that cycle is going, because the stock market is full of very smart people. I wouldn't say they measure the cycles as such, but the analysts that look at particular stocks, they're not dumb by any means. They know what they're doing, and they'll look at housing stocks and they'll look at commercial stocks. But any stocks that are dealing in raw land, particularly, that have to buy land for their profits that they build on, I would estimate that by the time we get to 2025, those analysts will be saying, hey, these companies that are having to base their profits on buying land, the profits are not going to be there the next year or two, even the year 2 or 3 ahead. So the analyst will start marking down those type of stocks. So if the real estate cycle is going to work, the land market is going to tell us first, and the way you look at that is always in the stock market. So we'll have to see how it pans out. But if you've studied a little bit of what Fred Harrison had to write in his marvelous studies of the land market, it's the land market that peaks first. And so often the land market's peaked while the rest of the stock market's still going up. So nobody sees it. So we've got stuff to watch, and you've got stuff to watch now about what happens, and the stock market will tell you. So I don't need to guess that. The same happened in 2005, so I'd be looking for the same again. I would never second guess the stock market. I believe I can read it okay, and currently the March lows are higher than last year's lows. So far that's bullish, but it remains to see whether we go up from here or not. It's higher lows, but that doesn't automatically make it a given that we'll move into all-time new highs for the US stock market. I think we will, but we have to see how that pans out. And the land market will tell us. The land market, then credit, then commodities, then it turns over.
Yeah, but that's my point. Real estate's kind of stalled from the parabolic rise.
Well, yes, we had a recession. I think real estate stalled back in 2002 as well, and came back. I agree with you. Some areas commercially are in a difficult market, and it doesn't help that people are still working from home. But from what I see, stocks with the housing and the housing market, the stocks indicate that the housing market in the US is still going pretty well. So
yeah,
until
I still think
there's
it's
a few
strong.
housing stocks just about to enter new highs. So housing as such, I think, is still going okay.
Okay, well, when we return, we'll talk with Phil J. Anderson about more opportunities to seize asset classes he likes and doesn't like amidst the uncertainty of 2023. When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back with Philip J. Anderson, and the free book giveaway is his book, The Secret Life of Real Estate and Banking, tracing the history of housing cycles in the U.S. and the banking system. So, folks, give us a call, 888-988-JOSH. If you call us right now at 888-988-JOSH, we'll give you a free copy of the book when you schedule and keep your no-obligation review. As we have concluding thoughts, Stan, do you have a final question?
I would just want to address one thing, and that is a concept that I've looked at very closely, Phil, and that's translation. And for example, in your 18-year real estate cycle, 18, by the way, is a Lucas number, which might be the mathematical derivation of that cyclical series. But in a bullish environment, we tend to see the crest or the high point of the cycle occur to the right of the midpoint. So you pointed out that the cycle typically runs up for 14 years and down for 4, meaning 18 years trough to trough. Right translation, of course, because the midpoint of an 18-year would be 8 years. If the cycle were to crest or to peak to the left of the midpoint, i.e. sooner than 8 years, you would have left translation. And that would be indicative of an ending in the bull market in real estate. So that's something that I would be closely watching for.
Yes, yeah, well, that's fair. Again, I do think this is where it's advantageous for real estate people to learn how to learn about the stock market and how to read a stock, which is what W.D. Gann was so good at doing. So again, I think the stock market will tell us. So we have to see what's going on. And so far, year ended in 3. It's been a classic year ended in 3. There've always been banking problems 20, 60, 90 years ago. So they're past us now. So I just think we'll repeat. And yes, you could be right. It could be a bit of an early crest. That's always the case. But again, there's enough stocks in the stock market to tell us. And so we'll just have to see what pans out over the next couple of years.
So speaking of asset classes, what asset classes do you like in this environment?
Well, again, the stock market and real estate markets will probably tell us fairly soon. Gold's had a good run. If gold breaks into if the price of gold breaks into all-time new highs, somewhere above 2,000 US, that's bullish for gold. That would probably be also bullish for commodities if the dollar declines, which it normally does in the second half of every real estate cycle. So we may be witnessing that shortly. That's very bullish for commodities. So copper ETFs and copper plays and things. I go through this in the service I run in the Signal. So we detail all the stuff in specialty what we're looking at. So gold, commodities. I'm not a crypto expert, so I would defray to other experts on that. It's I don't know enough about that market, but given what it's doing at the moment, it's probably a little bit behaving like gold. So we'll have to see. But there's a few things you'd definitely be looking at. And of course, with the real estate market, a lot of it's dependent on whether you're in the real estate already or whether you're not. I always encourage people who are new into the real estate areas, if you don't own your house, I've always encouraged people to at least own your own home if you can do that. It's always good to be a homeowner. It teaches you responsibility and how to look after stuff. I think it's much more wealth building than just renting. So it depends on one's finances and where you are as such, but that's the sort of stuff that I look at.
Well, I want to thank you for joining us, Phil J. Anderson, all the way from Singapore. So thank you for the time difference. And folks, you can Google Phil J. Anderson and you can get his book, The Secret Life of Real Estate and Banking, for free when you schedule and keep your no obligation review at 888-988-JOSH. That's 888-988-5674. Thank you so much for joining us, Phil.
Oh, thanks, Josh. That's fantastic.
Bye now.